Hey guys, so I published a couple articles the past couple of weeks talking about how the layer one blockchains like Ethereum and Solana should be valued. So basically, I was saying these layer one chains are more similar to sovereign states, nation states, national economies, rather than to companies or stocks. So you should look at them and value them as you would value a currency of a country instead of the stocks of a company. So after I published these couple articles, I got some interesting questions from readers. So today I will try to answer some of them. And I want to thank David S. for compiling some of the questions that showed up in some of the Twitter threads that I pushed out. So thank you for that. So basically, the idea I was trying to say is if you look at the economies of Ethereum and Solana and Avalanche and, Phantom and so on, these are more like economic ecosystems, right? With the layer one blockchain providing a infrastructure and security layer for the development or the so-called dApps to run on top and different applications for DeFi and NFT and so on and so forth can be built on top to form a economic ecosystem where different activities happen and different players rely on each other. So it's very similar to a economic system of a sovereign state. And the native token of the platform is just like the currency of that nation state. Now, there are some distinctions here. Obviously, it's not one-to-one comparison. It's an analogy, right? So these layer one tokens they are like currencies, but they are also like stocks. They're like bonds. It depends on how you use them, right? So they have these combination of characteristics. But the thing is, the bigger the economy grows, the bigger the platform's economy grows, the more these will act like currencies. And what will determine their price, quote unquote, exchange rate, because what people usually care about is their exchange rate vis-a-vis fiat currency like United States dollars, right? So what determines their exchange rate with other currencies in the long run is the size and growth rate of their economy. In other words, the GDPs of their economy, right? It does not. A lot of people fixated on the dividend flows. Oh, how much revenues this protocol is receiving. I think that's kind of misguided. That is capturing the, people are trying to draw the analogy, the similarity between these tokens and company stocks, and they're trying to use the valuation methods like discounted cash flows or PE ratios to evaluate these tokens. But the thing is, yes, these are sort of like stocks, but they are really a lot more like currencies. So basically, what determines the price of the currency, in other words, the exchange rate, is how much this is needed to run an economy, right? The bigger the economy, the more the currency is in demand because you literally need the currency to make transactions. In this case, every transaction you conduct on a layer one chain, you have to pay some transaction fees, and then transaction fee is paid in native token, and that's where the basic level of demand is coming from. And we're not even talking about the demand for staking and for yields and so on and so forth. So that is why there is a I think you'll find a long run relationship between the size of the economy of these blockchain nation states and the value of their tokens. Now, there are short-term fluctuations for sure. It's not going to predict what the day-to-day price of the token is going to be. And there's also, the market is a speculative market in the short term. And there are market cycles that, sometimes the demand far outstrips the supply in the market because of speculative cycles. But in the long term, the price of these tokens, in other words, the exchange rate of these tokens, should follow the size and the growth of the on-chain economy. So that was what I was trying to say. So let's get to some questions. Now, first question, are you suggesting that the proof of stake layer 1 chains will replace sovereign global fiat currencies such as the dollar, the euro, etc., or is it more like they will function in tandem with those fiat currencies? They're not going to replace fiat currencies because fiat currencies are currencies of nation states too. I live in the United States. I have to use dollars. I have to use dollars to pay my taxes, right? I have to use dollars to buy my, daily, expenditures, goods and services. That's not going to change as long as that does not change. As long as the real economy, the physical economy still exists and nation states still exist, the fiat currencies will exist. And that's why you also see, in smaller countries, there's this so-called phenomenon called dollarization, right? So in some countries, their local currency, the quality of their local currency is not great. So people prefer to use dollar. But very rarely do you see an economy that has 100% dollarization. Even in countries like Argentina, Venezuela, the currency is not great and people have very low confidence in the local currency. So people really, really prefer dollars. But why doesn't the local currency die? Because you still need it to pay taxes. Government still, accept it as part of the obligations that you have to pay for the public services the government provide, and that's a big deal. And that, in a lot of countries, that don't have a credible monetary policy scheme, that's what keeps the currency alive. Is the public sector's role in the economy. Okay, so that's not going to replace fiat. Second question, how does issuing more SOL or AVAX, those are native tokens of Solana and Avalanche, how does issuing more of these tokens get the economy of Solana and Avalanche going? So this is referring to a comment that I wrote in one of the articles. I was saying, just like the Fed prints US dollar to get America out of COVID slump, new layer 1 chains like Solana and Avalanche issue more SOL and AVAX to get their economy going. So how does this work? Well, a lot of these layer 1 chains, they are giving out incentives for development activities, right? They're giving out grants in terms of native tokens for people to actually to incentivize people to build stuff. In other words, to construct, to incentivize the construction activities in the economy. So that is one, right? So that is literally like the economic stimulus that the Federal Reserve will give, put money in people's pockets so people go out and spend and use and invest. In this case, you give incentive for development teams to build stuff on your layer 1 chain. And also, these are also, incentives you give as staking rewards to the system validators, because these are the so-called proof of stake chains, right? So you need to give rewards to people who put up their token as bonding to earn the right to process transactions, and as the reward for processing transactions, they earn some native token. And part of that, at least right now, part of that revenue that validators earn is from the revenues of the protocol of the layer 1 chain. But since most of these chains are still small right now, a lot of the rewards are actually inflationary rewards, meaning literally the protocols, gives out more new tokens to validators. So this is again, it's an incentive to incentivize people to participate in the chain. In this case, to provide security for the chain. So, and also if you, like in some chains, if you open a new wallet and you do some transactions or you put up a, minimum balance, you will get an airdrop of the native token. I think AVAX does this. How much I don't remember how much they give out, but I remember when I first, opened an AVAX wallet and I put some tokens in it and I automatically got a airdrop. So these are, just different ways for chains to incentivize people to actually do something, to invest, to consume, to interact, create economic activities on their chain. All right. Okay. Next question. Please give specific examples of where the traditional financial system is clogged and where it's leaky to help us understand the shortcomings of traditional finance. So this is, again, it's referring to something I said in an earlier article. I said the Federal Reserve has to rely on traditional financial system to push its monetary policy out to the economy, but TradFi is a crappy pipe, clogged in places it should flow, leaking in places it should hold. So this is asking what I mean by that. What I mean by that is, if you think about the traditional monetary policy of the Fed, right? You have the basic tools of monetary policy, such as lowering interest rate. But when you lower the interest rate, you still what you expect to happen is you expect banks to lend out more money, because theoretically, if you lower the interest rate, it gives more incentive for people to borrow. It's cheaper to borrow, right? So it should theoretically encourage credit creation, and credit growth is usually associated with economic growth, because again, you borrow to do stuff, right? So you borrow to build houses, to purchase things, and that stimulates get the economic cycles going. So, but the problem is it works to some extent, but at some point these tools stop working. For example, we are in a very, very low interest rate environment, right? So if you're already in a low interest rate environment and you keep lowering the rate even more, what happens is banks throw in the towels. Because you think about, when you operate a bank, where does your profit come from? It comes from the margin that you get from your lending rate and deposit rate. That's the profit that you make as a bank, right? Now, when you're lowering the lending rate, when the interest rate is dropped, your lending rate drops, right? So that squeezes your profit margin. Your deposit rate already very, very low, and keep in mind there is a zero lower bound. You cannot, like, banks, at least so far, haven't been giving negative interest rate to savers, right? So on the lower end, the deposit rate you give out has it zero lower bound, but your lending rate keeps reducing, so your profit margin gets smaller and smaller. And what happens when your profit margin gets smaller? You have to give out a bigger quantity of loans in order to make the same amount of money, right? So how do you give that bigger quantity of loans? You have a cost for giving out loans. Okay, it's not like you can just hand out those loans without any kind of due diligence. So if you give out 10 $1 million loans, you have to do 10 due diligences, and roughly speaking. So if you want to if your margin is reduced, you have to really expand the quantity of your loans. It's not an easy thing. So at some point, you don't feel like giving out more loans anymore, because it just means more work to you. And there is a limit to how much more due diligence, how much more loans you can do, right? So what do banks do? You give out bigger size of loans. You stop giving out smaller size loans, because that's no longer profitable for you, right? So you give out bigger size loans to bigger companies, because those are the ones that need bigger size loans. And so what happens is, when that causes the huge capital misallocation problem in the since the financial crisis, even before that, before 2008. Okay, the Fed keeps lowering interest rate, so because theoretically they will stimulate the economy, stimulate lending, right? But you like banks have to push out more loans, but banks cannot keep doing that with the smaller sizes loans, because you every loan you give, there is a fixed cost, right? So you have to go after the bigger and bigger companies, and forget about the smaller, like mom and pop shops. Forget about the smaller consumers. So what happens is you have the access to capital of large corporations, whether they're profitable or not, whether they need money a lot or not. The cost of access to capital for bigger corporations gets lower and lower, but the cost of capital for smaller companies, for startups, for your Main Street, mom and pop shops, the cost of capital do not decline and even increase. It's a funny thing. As a startup, smaller company, you still need to pay like 20 to 30% for working capital loans, and I think that's still on the cheaper side. And on the other hand, bigger corporation, bigger companies, they're swimming in liquidity. So the cost of access to capital is very, very low. So it creates this very imbalanced economic structure. That's why that's what I mean by it's clogged where it should flow. Well, the places it should not get money, it gets money, and so and also banks with all this liquidity, they don't want to lend, right? Because you cannot literally deploy so much capital with smaller amount of loan size. So banks put them in, corporate bonds, in alternative assets. That means, companies that are large enough to get access to the bond market, they have very low cost of capital. The rest of the companies, the restaurants next door to your house, they don't get access to corporate bond market. Okay, so that's over time creates this very peculiar imbalance in the allocation of capital, and that is not good for the economy. Same thing with the asset purchase, the so-called quantitative easing of the Federal Reserve. You basically purchase asset and you get liquidity into the banking system. But banks don't want to use that liquidity for lending for the reasons that we just talked about, right? So that's the thing about traditional financial system is you have to rely on the traditional banks. And traditional banks is not working very well. Okay, so and I had another article talking about what's the competitive advantages of DeFi over traditional banks. I recommend you check it out if you haven't. I will try to link it in the video below in the description if I remember. Okay. All right. Next question. So it says you mentioned proof of stake gives citizens meaning the validators and stakers in the economy a sustained motive to hold the native token. Is the bigger distinction you're trying to make here between proof of work and proof of stake that proof of stake gives people steady yield plus equity appreciation, whereas proof of work only offers appreciation? Yeah, so like Bitcoin, for example, it's proof of work system. So, and there is not much of an economy built on Bitcoin. Now, people are trying to do that, and I don't see a point of doing that because Bitcoin is not a very scalable chain. But, each to their own. People are trying to make the Bitcoin smart contract system work, and I just don't see the point. But the thing is, Bitcoin is proof of work, so who gets the transaction fees? The Bitcoin miners, right? So in a proof of stake system, the validators who put up capital to locked up capital in order to earn their right to validate the transactions, they get a reward. and also people who tag along. Like I can delegate my Solana or Ethereum 2.0 to some other validators, so I earn the same staking yield as they earn, minus a bit of a fee that they take for providing the service, right? So so you see, if I buy Bitcoin, I don't get any yield at all. I don't get reward from the economy. The miners get the reward. So the incentive for me to hold Bitcoin is to expect the price to go up tomorrow. Okay, so that will probably happen. Bitcoin price will probably go up, but the thing is, it will not go up forever. So how is this going to be a sustainable system, right? 20 years down the road. But with proof of stake, even if the token price is not going up, you still are getting the yield every year. You are participating in the economic system, and as we said, as I mentioned earlier, the bigger the on-chain economy grows, the more value added that gets generated on-chain, it's gonna benefit the stakers, and those are the people who get the rewards. Okay, so that's a major distinction that I see here is in terms of the distribution of economic benefit between proof of stake and proof of work. Proof of stake encourages more wider democratic participation in the on-chain economy, because everybody can get a piece of the pie in terms of the value added generated by the economy. Proof of work, there's no such thing. There is no such distribution. So, okay, so next question. It's about the delegated staking and liquid staking. What do I mean by those? So basically, like I just explained a little bit, delegated, I think on Solana, on Ethereum too, actually on every chain. It's you have to hold a certain amount of token in order to become a validator, right? And even though you have that amount of token, you may not feel like running the software to actually validating transactions. So what you can do is to tag along someone else who is actually running a validator node, and you stake through them, and then you get the staking reward. So that's delegated staking, and there's no minimum amount that minimum requirement for how much token you have to stake. You can stake a little bit or a lot, depending on how much you have. Liquid staking is like, so usually the staking on layer ones, there is a lockup period, right? So I think on Ethereum 2 is like, it's very long. I forgot how long it is, but it's you cannot get, if you stake ETH2 now, you cannot get it out until after Ethereum completely moves to proof of stake, and who knows when that will happen. And then even after that, it has to, like, system has to run, after a certain benchmark is passed, certain milestones are passed, before you can take that stake out, before you can unstake. And I think on Solana, if you stake and you want to unstake, it takes like maybe 2-3 days to get your tokens out. So if you don't want that staking, that lockup period, there are services that give you that liquidity. So essentially they manage the book of all their clients, and they have their own liquidity. So if you want to take the token out, they give you the token. Tomorrow you said, okay, I don't want to stake Solana, my SOL anymore. Give me this amount, my SOL back plus the staking reward, and they will do that. And since they're providing a liquidity service, they take a cut. They take a fee, right? So that's a liquid staking. Okay, next question. So I said staking increases the stickiness of the on-chain economy citizenship, the citizenship of the proof of stake chains nation state. It boosts price stability of everything denominated in the layer 1 token and lowers transaction cost. And the question is, how does this lower transaction cost? Well, here's the thing. Transaction, so whenever there is, if the value of the currency is very volatile, it increases the transaction cost of every transaction. Especially if that transaction is of a time dimension, like lending and borrowing. Or if I'm a company, I need to set a price for a product, and that price needs to be stable over a period of time, right? So if I sell this microphone, I have to set a price. I don't know, $200, and I don't want that price to change every day, right? So, which means the value of dollar better be stable. A year from now, $200 should mean roughly the same thing as $200, what $200 mean today. Otherwise, I have a problem as a company. If dollar depreciates 50% a year from now or appreciates 50% from now, I don't know how to run a company because I cannot change my price every day. But at the same time, I have cost, right? I have to hire people, I have to pay people, I have to pay my vendors and suppliers. And all of these costs I incur these costs in different time frames. And if the dollar price is not stable, unless I keep changing the price that I sell the microphone for, otherwise my profit is going to shrink or expand in a very unpredictable way. And it's going to be a huge problem for me as a business owner, right? Same thing with lending, borrowing transactions. If the currency value, no matter in which direction it changes, it better not change a whole lot. It better be stable so that both lender and borrower have a clear expectation in terms of what the borrowing contract actually means, right? So that's why I cannot, nobody's going to borrow Bitcoin for a mortgage. How do you borrow Bitcoin for a mortgage? I tell you, okay, I lend you 100 Bitcoin so that you can buy a house. You pay me back over 30 years and charge you 3% interest rate. But, remember this is Bitcoin, okay? So you pay me back in Bitcoin, 3% a year over 30 years. But you're expecting Bitcoin to appreciate a whole lot. But how much? You don't know. You don't know what the exchange rate or what the value of Bitcoin is going to be 30 years down the road. So you're not going to enter this contract. This contract is going to involve endless negotiation because you and I are never going to agree on how much the interest rate should be because neither of us know what price Bitcoin will be 30 years from now. Okay? So I will feel like if you pay too low an interest rate, I will feel like being cheated for lending you that money, right? If you pay a 3% interest rate, you're like, okay, if Bitcoin price goes up 1,000x, 30 years from now, you're going to pay like a whole lot more than the value of your house. So these are transaction costs. So whenever you have currency values fluctuate wildly, it's not good for economic activities of any kind. That's why, every central bank, what they try to do is to achieve price stability because they want to minimize transaction cost and set a stable, predictable expectation for everybody that is conducting economic activities on their platform, in their economy. Okay, so at least that's the intention. Whether they do a good job or not, that's a totally different question. Okay, but that's the intention. They want to stable the economy. They want to stable the price level. So How does that relate to the layer one chains? When you have a proof of stake system, you encourage people to stake, right? So you discourage the kind of fast flows in and out of this currency. If you have like a huge flows in and out of currency, you make the price volatile, right? On the other hand, if most of the time it's stable, there's not a lot of buying and selling in this market, your price is more stable. So in the long run, it's going to reduce the transaction cost of the economy versus a scenario where the currency price is not stable, right? So like, for example, for Bitcoin, I don't think it will ever be stable because there's just no anchor there, you know, compared to a proof of stake system. Now, but still, none of what I just said apply to the short term, because in the short term, all of these economies, on-chain economies, are expanding like crazy, right? So in the article, what I said, and I just explained 5 minutes ago, in the long run, the currency price should be positively correlated with GDP growth. So if you have Ethereum economy growing like 200% a year, you cannot expect the currency price to be stable. Okay, so but that said, this is because we are at a very early stage of these on-chain nation states being built from scratch. So it's very early, so none of these currency values are going to be stable right now. Okay, so but this is what I was talking about is more of, in the long term. I think the proof of stake system is going to have a more stable currency value compared to the proof of work system. Next question. What are the risks to the reliability of layer one yields, and what could make one of these layer ones collapse? Okay, here's the thing. We have, I think, over 30, 40 so-called layer one chain, and a bunch of them don't have any traction at all, and a bunch of them is a bunch of promises of what will happen, all the great, wonderful things that will happen tomorrow. Which means they don't have users, they don't have apps built on top right now. It's not going to happen. It's all going to happen tomorrow. That's the story. That's the narrative. Whether you believe that narrative or not, that is your own judgment. Okay? So to me, I only buy the ones that already have traction. So I think that, besides Ethereum, my biggest holdings right now are Solana and Avalanche. I'm not saying others are not going to succeed. I'm just saying these are the ones I'm focusing on, okay? There are a lot of opportunities in the blockchain space. Nobody's going to catch everyone. So, but these are the ones I'm interested in. I'm not saying other ones that I'm not buying are going to fail, okay? So, but if you're going to buy those, you better do your due diligence. You better figure out what stage this chain actually is in, okay? So, which means you look at user growth, you look at wallet growth, you look at transaction growth, the TVL growth, all these, development activities and, bridge activities and so on and so forth. There are a lot of metrics that you can look at to see if there are actually activities happening on this chain, if there are a economy being built here, or is this just a white paper, or people giving out, narratives of what this on-chain economy going to be look like next year. So there's a distinction there. So that obviously, all of these are very new. So it's a high risk space. You gotta do your own homework. Okay. What will make one of these layer ones collapse? Well, if nobody uses it, you don't have an economy. So so yeah, so it all boils down to if there are actually actual economy being built on chain, on this blockchain platform. Next question. So I mentioned in the article that some DeFi products like Anchor, they're using layer one staking yields on the back end to offer saving rates on like a US dollar stablecoins, for example, with close to 20% interest rate. So the question is, if those products are available to customers, why wouldn't they just hold stable coins for that 20% yield instead of staking layer one tokens themselves? Well, because because we are in a stage where these layer one tokens are appreciating a lot against fiat currencies because their economies are growing a whole lot. Like we just talked about, United States grows 2% a year, okay? The world economy grows like 3% a year, but how much does the Ethereum economy grows a year? 200% or something like that. You can look at, go look at the wallets and the transaction volumes and statistics. And other economies are growing even faster because they're smaller, the base is smaller, so the growth rate is faster. So their currencies are appreciating a lot more compared to fiat currencies whose economy grows to 2% a year, right? So if you hold fiat currencies, you earn 20% from a product like Anchor, yes, but I don't do that. I don't do that because I like holding I like holding ETH, I like holding Sol because those economies are going to grow. So that's even though the nominal staking yields on those are lower, like I think something like 5 to 7% on ETH and Solana staking. Okay, but you have the appreciation of the underlying token. But of course, you don't know whether they're going to appreciate or depreciate or where the market cycle is. Maybe they all collapse tomorrow and you go into a crypto winter and so on and so forth. So you have a higher risk. So that's the thing. You either get a 20% on the stable coin or you make a bet on, native crypto tokens and then you get a staking yield. It's your preference. It's your risk reward preference. That's different to everybody. Okay. So, and the next question, is this one of the ways that fintech companies like BlockFi and Celsius offer high yields on stable coins? Well, these companies, I think they do a combination of things. They definitely stake. They do like yield farming. They do staking on layer one. They do like DeFi, yield farming. They also do, just normal, lending activities, lend to their customers. If they have a huge volume, they lend to the short sellers and lend to the arbitrageurs, hedge funds, so on and so forth. So they do a combination of things to generate the yield. And that's basically the value added. They hide all of that from the end consumers. So all you need to know is, okay, I get a 8% yield on my stable coin, for example. They do all this, manage all these books on the back end, okay? And that's the value added of the business. I mentioned products like self-paying loans or low loan liquidation risks by staking the collaterals from borrowers in proof-of-stake chains. What are these products? Do these products and lower interest rates charged to borrowers? How are they self-paying? Well, they're self-paying because the idea is you borrow, from these DeFi protocols, and you you have to put up a collateral, right? So your collateral is ETH or Sol or something else, and the protocol, the DeFi protocol, then uses these uh, your collateral to do yield farming. So you don't do those, you don't do them, and they do them. They do these yield farming and they generate a yield using your collateral. So that yield generated by your collateral pays for your loans. That's what self-paying loan means. So if you're interested, you can check out things like Alchemix or Abracadabra, and see how those works. It's a rabbit hole that you can go down and do research all day if you're interested. Okay, but the bottom line is you have these building blocks that the layer 1 chains provided, including the staking yields on their native token, and then you have the DeFi Legos can be built on top, and people are experimenting with different types of product offerings. Some of them will stick, some of them won't, but that's the beauty of this space, is innovation happens fast and people experiment. Okay. Next question from Athanasius. What's stopping the world's government from stopping this? This meaning like layer 1 blockchains becoming like quasi nation states. Okay. What's stopping the world's government from stopping this, as it would seem to take away their power over monetary policy? Yeah, sure. That's why governments do not like things like stable coins or crypto like Bitcoin or Ethereum, other things, because they're threatened. And right now it's still, it's a 2.53 trillion asset class. It's pretty small, right? It's just starting to get systemically important. So governments are starting to wake up. And that's why governments are scrambling to push out their CBDC, their central bank digital currency, because they don't want to be outcompeted by private sector tokens, right? Now, how much they can do is a different question. The immediate threat is not going to be the Ethereum and Solana of the world. And the immediate threat is going to be stable coins, the US dollar stable coins or euro stable coins, because like we talked about, a lot of countries in the world, they already have dollarization problem, right? People prefer dollars because it's a stronger currency. It comes from stronger economy, and the native currencies of some countries are not very good because the monetary policy not very credible. So the immediate threat in crypto with the stable coins just make dollarization a whole lot easier. So the immediate threat is from the stablecoin dollars. That's why all these governments they want to have central bank digital currency. I think some of them may be barking up the wrong tree because it's like central bank digital currency. The problem is solved is ease of payment, ease of transaction. Okay, it does not solve the currency. It does not solve the problem of sometimes people have low confidence in their local currency. If they're like Argentina peso that depreciates like 50% a year, how are you going to have any confidence in the currency, CBDC or not? So the CBDC is not going to solve the quality of currency problem. Yeah, it maybe make payments easier. So what? So I think some governments are going to come to that realization soon. So, but this is a good thing. So because in the long term, we're going to have public money, government money. You're gonna have private sector money. We're gonna have tokens like these layer one tokens that are semi-money. They're not exactly currency, right? They're sort of like we talked about. They're a combination. They have some qualities of currency. They have some qualities of bonds. They have some qualities of stocks. So all of these things are gonna coexist. So over the long term, more competition is good because without competition, what happens? If the government's issued money is the only money of the land, it's absolute monopoly. They can do whatever they want, right? So that's why a lot of countries run shitty monetary policies because they can, because there's no competition. So more competition is going to be great because it will be, both the public sector and the private sectors will have to be would need to keep their act together, and you will have less stability problems in currencies, either public or private. So I think over the long term, this is going to be good for the quality of monetary policy execution in both governments and in other token systems or the virtual nation states. Okay. Next question from Sean G. You've said many times that a economy needs the purchasing power of money to be stable. Yeah, because we said lower transaction costs, right? So you need to expect the token price, the currency price exchange rate to be stable. You need to have a reasonable expectation that the same dollar is worth similar thing tomorrow or the next year compared to today. That minimizes transaction costs in the economy. It encourages the commerce, encourages transactions and different types of economic activities. So you said many times that you need purchasing power of money to be stable, and that a sharp rise will give rise to credit crunch. Yeah, it would. Because just like the example that I give you, if I propose to lend you 100 Bitcoin, 30 years mortgage, fixed interest rate, you will not do it, right? So it would discourage credit for sure if your currency is supposed to be sharply rise in value over the long term. Okay, so what's the question? Okay, I guess the question is how does that square with the currency value will go up when the economy grows. Okay, so these layer one tokens gonna appreciate. So are they good currency or not? So I guess that's what his question is, whether these layer one tokens are good sound money or not. So like we just discussed, in the short term, it's impossible for these values to be stable. Okay, we're setting aside this speculative part. It's a huge, because this is an entirely new sector, huge speculation, so much money flowing in. You're gonna have huge boom and bust cycles. So any kind of stability just goes out the window in the short term. In the long term, and also on the other hand, you also have the economy, on-chain economy really is growing tremendously, right? And then as we talked about, with GDP growth, the value of the currency should grow. If your GDP growth 200% a year, value of the currency should do the same, right? More or less. So that's not going to have stable values in the short term, whether it's proof of stake, proof of work, or proof of whatever. But I did make the point that in the long run, if you want to keep the currency value stable, the supply of the currency, your M2, M3 should match the supply growth of the money, should match the growth of the economic growth, because that's how you keep the currency value stable. because you need to have sufficient money to cover, roughly speaking, a certain amount of activities, right? Assuming your velocity of money is relatively stable. It's your velocity of money, of course, it changes, but it has a range. It does not change drastically, okay? So if velocity is relatively stable, you have a certain quantity of money. It can cover certain amount of activities with stable price. If that amount of activity expands so much and your money supply does not expand, you're going to have huge deflation in prices of goods and services in the economy, and that's not good. Okay, so because like we already talked about multiple times, you want price level to be stable. So what do? You expand money supply to keep up with the activity, was the amount of activity happening in the economy, the GDP, in other words, to keep price level stable. So ideally, I think that's what a sound money does, is target stable prices. Now, obviously, that's not what these quasi currencies do, because everybody wants this, marketing meme of limited supply so that attract people to hold their currency. All right, nobody wants to hear, oh, our inflation rate is 10% a year. While in reality, if your economy grows 200% a year, you have 10% a year increase in your token supply. It's a drop in the bucket. Okay, that's already a deflation, hugely deflationary economy. But people don't want to hear that, because people want this meme of limited supply, because people want the price to go up, currency price to go up. I think in the short term, fine. In the long term, I think people will realize the value of price stability in the economy, whether it's on-chain economy or in the real economy. In the real economy, people, realized that a long time ago. That's why central banks all try to target price level, like inflation rate, do some sort of inflation targeting, although they're not doing a good job recently. That's why people complain a whole lot. But the thing is, just because the fiat currency has depreciated or the price has inflation rate has increased in recent period, does not mean a deflationary economy is good. No. What you really want is price stability. So in that sense, none of these currencies are sound money. So, but that's fine, because these are quasi currencies. It's not like it's not like on Solana platform. Yes, Sol is used as a unit of account. If you buy an NFT, it's denominated in Sol, right? But if you borrow a land, it's still, most of the time it's in stablecoin. So you will have a combination of things. I think you have a combination of tokens sharing the unit of account, medium of exchange, and store value functions. So these basic functions of money. You will have different tokens sharing these functions on any platforms. So overall, I think it will be fine. As long as you don't have one deflationary currency throughout the system, and there's no other currencies, no alternatives. That's not good. Okay, and that's what the maxis all want. They want one token, rule them all, and nothing else. That's not gonna work. But I think the current system is fine. I think that over time it will evolve to be, different tokens. They share across these functions with more emphasis on one of them than others. Like, for example, Bitcoin, it will be more of a store of value function compared to the medium exchange or unit of account function, because it does a terrible job as a unit of account, but it can serve as a store of value. So other tokens they have other, serve other roles, and that's totally fine. So over time, we may see this, unbundling of what we call money. So these different functions gonna be carried out and be served by different types of tokens. That's what I think will happen. So these layer 1 tokens, they are some unit account functions, but they are still currencies in the sense that, you need them for every transaction on this platform that native token belongs to. If you are on Ethereum, you have to spend ETH in everything you do. So in that sense, it's currency used in transactions, and the demand of this currency grows as the economy of Ethereum grows. So all this, traditional, like all this, like evaluation of currency valuation model, quantitative model of money type of valuation model for exchange rate still applies. Okay, so wow, that's almost an hour. That's terrible. Thank you if you're still here. Well, thank you for listening to this, and I will talk to you later. Okay, bye.